We have these three major regional bank failures. We're looking sort of in the rearview mirror to learn what went wrong and what can we do to avoid it next time. So what's your take basically on what went wrong?
A number of things went wrong. First, we made meaningful changes in the regulatory scheme governing large regional banks. With the benefit of hindsight, that was clearly in error. We've had three large regional banks fail, all in ways that impose significant hits to the deposit insurance fund. So clearly the deregulation was a problem. The banks themselves were a problem. It looks like they were taking a lot of risks without understanding those risks, without appropriately hedging those risks and managing those risks. And there were also shortcomings in supervision. It does look like some of this should have been identifiable, some of it was identified, but supervisors didn't act quickly enough and aggressive enough in escalating the concerns in ways that actually would have resolved the situations before we had such messy failures.
We've heard a lot about interest rate risk, which is a terrible thing to have, obviously, we've just seen. At the same time, given what the Fed was doing, it shouldn't have come as a surprise to the banks or to the supervisors that there's interest rate risk. I mean, we were raising interest rates like at an unprecedented pace.
We were, and the Fed really did signal that. And again, there was a long period of low for long and a period where rates were going up more slowly. But first of all, interest rate risk is a classic bank risk. I mean, in my very basic banking classes, I go back to the SNL debacle and I show how a changing interest rate environment affects the value of all assets that banks hold. So this is what banks are in the business of doing. And as you just pointed out, the Fed really did signal this. They said, look, we're really worried about inflation. There are concerns about inflation, and we're going to tighten as long as we need to really get that inflation under control. So both the amount of interest rate risk, the lack of hedging around that risk looks like a really inappropriate way of managing those risks.
The reason we look at these things is not just to say, I told you so, as much fun as that might be. We saw some of that maybe in Congress on Capitol Hill this week, actually with some bank leadership. But to say, what should we or could we be doing differently for the future? What did we learn, and did we learn it specifically about regional banks as opposed to the very big banks, or for that matter, the community banks?
A little bit of all of the above. So the biggest lessons have to do with regional banks. That we saw three large regional banks fail. Two of them fail in a way that required regulators to invoke this systemic risk exception, suggests that that is where there was the biggest gap between what the regulatory scheme ought to look like and what the rules actually look like. But we also saw the failure of Credit Suisse on the other side of the Atlantic. We saw a rush merger with UBS that raises concerns about resolution planning. And there was already some meaningful work underway for Basel III implementation, which basically just means even the largest banks are going to face some tougher capital and liquidity requirements, and that's probably appropriate.
Is there also a potential flaw in the business model? And that is to say, you're taking deposits that by definition people are going to have whenever they want. So you're getting funding that is very, very short term, and you are necessarily putting it in longer term investments, such as 30-year mortgages, but also, as we learn, treasuries. Does that inherently put a lot of banks at risk?
Yes and no. So, I mean, the business of banking is to engage in maturity transformation. So there is a fragility that exists. On the other hand, it's been pretty well managed for a very long time, but then we have these periods of significant disruption. One of the things that's really striking right now is you look at the small community banks, and they've actually been remarkably stable. Even before the March turmoil, we saw depositors were leaving regional banks. They were leaving the largest banks because they just wanted to get a higher rate of interest than they were getting on their deposits. But the small community banks were really holding on to those deposits, and they managed to continue to provide meaningful credit. So it's not the entire bank business model. I do think we're seeing very real questions about the regional bank business model.
So what is, I'll use the term social contract, we should have with the regional banks? Because on the one hand, we want them to really support the real economy, as you put it. On the other hand, if they get in trouble, they turn to the federal government and say, bail us out. What should the essential social contract be with the regional banks? This is what we want you to do. We want you to lend money. We want you to help with credit. At the same time, these are the situations under which we'll actually help you out.
I was going to say, I think the social contract is part of what we're discussing on the Hill this week, last week, for the last couple of months, and in ways that have been really positive, right? I think one of the silver linings, if we can call it that, is revisiting this core question, not just with respect to regional banks, but banks generally. We are reminded of the fact that the government very frequently steps in to protect against losses. And here they allowed shareholders to lose money, they allow non-depositor creditors to lose money. But there were a lot of uninsured depositors that ultimately were protected. And so if you're going to provide that type of support, then you want to ask ex ante, what are we really getting out of that?
What about the non-banks? You mentioned those before. They certainly have expanded dramatically, certainly since the great financial crisis. Why can't we just turn a lot of it over to them? What's the risk in that? What's the downside?
So there's a number of risks. So one is they are part of the ecosystem. They're going to remain part of the ecosystem. So trying to say, should it be banks, should it be non-banks, is a false dichotomy. At this point, it's both, and they're also integrated in very meaningful ways. But there are a lot of downsides. I mean, at this point, banks are subject to very meaningful regulation and oversight. Ideally, that promotes their safety and soundness and the resilience of the system. But it also provides policymakers a lot more insight into how well the financial system is serving the needs of the real economy.
We talked about deposits and what you called maturity transformation. Some people at this point are saying a mismatch between short-term and long-term there. Some people are saying we should just federally guarantee all deposits without limit. What do you make of that proposal?
I mean, I think we need to rethink the structure of the deposit scheme. It doesn't make a lot of sense that I have access to deposit insurance at the same level of a mid-sized business that needs far more just to make payroll. That being said, at this point, we insure a lot more than just what we think about as deposits. It's not just your checking account. It's also a CD. And we've moved away from the days where we used to have interest rate caps on those deposits. There's a lot of reasons to think that we should rethink the structure of how we go about deposit insurance. FDIC has a great new report on how to rethink it. But just removing the caps without doing a lot of the other work that we would potentially need to do could also involve a lot of money flowing to a lot of very troubled institutions.